folks, in a continued effort to try and find a way to fast track my financial independence so one day I can retire early, I am always digging around trying to find the best dividend stocks that are going to offer me the most tax advantages as a Canadian, and I love them juicy REITs that pay well over 6% yields, and I got one today that I think I have been largely overlooking. I still think it's trading at a discount, and I'm going to do a full overview, so in the clarity of my transparency, consider helping the channel out, hit that like button, subscribing for future updates, and let's zoom out and kick this off by talking about SmartCentres. Now, I have never looked at this REIT too seriously because it deals with more or less real estate on the outer skirts of the city. Now, they do have some real estate within the city of Toronto where I currently live, but I ended up picking another REIT called REIT over this one because REIT is highly focused on the city of Toronto where I believe the most premium real estate exists. But today, as of their most recent filings for their Q 2020 earnings release, folks, we finally get to see how this company has performed, and I am jaw-droppingly impressed. So let's get right into this, taking a look. SmartCentres right now from its, going into 2020, it's still trading down about 14% from its high there. But from the very bottoms, I mean, it's trading up huge. Anyone that caught these dips, congratulations. You're up 50% and you probably capped in an insanely large yield of around 10% here, folks. And just taking a look at the dividend, unlike REIT, this stock has not cut its dividend. It actually increased it going into 2020, and it's been able to hold it there without doing any cuts, which we're going to take a look to see if this dividend is even sustainable here, folks. But they do have a good history of increasing the dividend as early as the end of 2019. So getting into this, before we get through the valuations, let's just take a look at SmartCentres in general, because they deal with everything from residential, storage units. Heck, I even think they sell cell tower stuff to like Rogers and TELUS and some of the telecommunication companies. But just taking a look, they have 34.1 million square feet of leasable space, 3,400 current tenants, Encore by Walmart, 115 of them, pretty stable business there, 3,500 acres of land, 167 properties, and $10.7 billion in assets here, folks. So just taking a look real quick, the only thing I care about is how did they do throughout this pandemic, folks? And similar to REIT, at the very bottom basement, they saw about 76.9% rent collection. And when you see this little rental collection, including CRA, that's basically tenants that were using the government to supplement their income to pay their rents. And we can see that happen all the way up till September. So I always look at this 73% as literally the farthest they can drop, because that's where like the really solid tenant basis is. And we saw a big incline up till about October and only seeing a further decline going into December. But honestly, if they can hold this 92 to 95% range, we're going to be fine. So with these percentages of rent collection, how does this break down into cents and ones and zeros here, obviously, guys? So we're going to go on to Yahoo Finance, and let's just take a look, because going from 2019, they hit a record high of $806 million in revenue, and it dropped off slightly to $781 million. And just taking a look at the balance sheet, because this is one of the main things I always tell you guys to look at when it comes to REITs, is how leveraged are they? And if we take a look at their total assets, they sit on $10.7 billion with a total liability right now of $5.5 billion, meaning they have about $5.2 billion in underlying assets, which if we go back to their market capitalization of $4.02 billion, technically they're trading about $1 billion against their underlying assets. So that to me is a little bit of a discount here, folks. Going into their actual fiscal earnings for 2020 here, folks, I love the fact that they nail these numbers so we can just see them right away. I hate when I have to do the math myself, but their funds from operation, as I told you, in REITs, it is the only thing that matters, because when we actually look at the revenue on Yahoo, it looks like their earnings per share just completely fell off a cliff, but that doesn't actually represent how much money they put in the bank, because these companies do write-downs like you can with vehicles and other assets that depreciate over time, and that really makes it look like their earnings are hindered. But I promise you, the only number that matters is the funds from operation, what actually hit their hands before write-downs and BS, as I call it. And we can see that they did about $2.14 per share. And luckily, they put the distributions declared right next to it at $1.85 per share, which means they're leaving themselves almost literally about a 40-cent leeway from the current dividend for what they're making. So they actually have room to pay this dividend. They still have room in case it fluctuates. And it's really showing the resiliency of their tenant basis during this pandemic, which literally 50% of their tenant rent is Walmart, Loblaws, Shoppers Drug Mart, Canadian Tire, Lowe's, Dollarama, RBC, Sobeys, McDonald's, LCBO, Rexall, Rogers, BMO, TELUS, CIBC. I mean, these are some of the largest companies in Canada, guys. So, I mean, We can see how that 50% tenant basis really cushioned the blow. I mean, it's literally almost the same thing as REITs, which I talk about a lot. But let's talk a little bit more about some of the forward-thinking stuff and why I became so impressed with this company in the first place. So I like the fact that they show you the continued construction momentum, because like REITs, I like seeing how this company is going to grow revenue in the future, how I'm likely to see capital appreciation, while also knowing that my dividend will likely increase moving forward. And we can see that a lot of the construction, they started from Walmarts. Here's some storage centers they finished last year, I guess. I mean, some condos, 1,100, closed 1,100 transit cities and 1 to 2 condo units in Vaughan. I actually see this building. I know I drive by this building all the time, but this isn't really what I want to show you guys. What I really want to talk about is the insane growth that we're going to see moving forward. They're claiming that they have plus 13.5 billion in projects, or 512 transformation plans here. And I want to explain to you a little bit more about this, because here they kind of just show the projects underway, 57 properties, 82 active, and 145 in the future here, folks. And I can't believe this when I hear it, but they have 284 locations, guys, or pieces of property that they're going to be constructing. And when I say that, it's so hard to believe when you're getting into the billions of dollars in real estate value, because this is just, I mean, you're so used to thinking about individual properties, and this is just next level stuff. But we are also talking about some of the largest, one of the largest REITs in Canada here, folks. And this is where things start to get wildly impressive. I am just going to scan through this, because this company is literally trying to build cities around their shopping centers. Because this company isn't highly focused in Toronto, they're kind of on this outskirts. If you know Vaughan Mills, outskirts of the city, still nice area, but they own these shopping centers and some of the surrounding real estate. So they are literally deciding that they are just going to build dozens of condo units around these really encored malls that have these really stable tenants. And they are in general just staggering to me. I mean, check this one property out here, guys, the Cambridge Vision. There's what, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30, 31, 32, 33, 34, 35, 36, 37. I'm rambling, but that's literally how many condo units they are going to put up. And if you understand one thing about Canadian real estate, while I scroll through these endless projects that they're going to be constructing, guys, you like me are well aware that the real estate market just exploded by like 20 or 30% in value. And it looks like we're going to see a continued hold of this just because of the foreign income buyers, the fact that we have such a limited supply. I mean, there's so many reasons that Canadian real estate is starting to look like Manhattan in New York. And when I see the fact that they are building these in relatively decent locations that are going to be affordable for the average person, I mean, guys, it like your mouth starts to drool, your eyes start to gleam. For me in particular, it might be a good idea because I own so much REITs, and that's where I focused all of my money in the crash, because I was buying REITs for $15 a share. And I'm looking at this one now, and even REITs that I still think are trading at relative discounts, but I'm like, hey, this would really complement my REITs real well. So I'm highly focused in Toronto, and then I have this booming future in this REIT here with a ton of upside value, and the fact that they already have a super stable tenant base is just like REITs, guys. So everything about this it's a beautiful thing, guys. So if you managed to pick this thing up on the dip, I'm going to applaud you in the first place. I overlooked this REIT because I didn't see what they had their vision in their future for, but now they're projecting their new vision, and they have the real estate to do it. They have, cash in the bank. I think they're sitting on about 700 mil. Don't quote me on that, but just taking a quick peek. Let's go back to the cash. Does it show me cash and cash equivalents about $794 million? So, I mean, more than enough capital to pay the dividend, lots of cushion room in case we see more headaches into this current pandemic that we're finally starting to get to the other side of. But if you believe like I do, we're going to wake up on the other side of this pandemic very soon. And the fact that these REITs still trade down from their all-time highs at relative discounts, the fact that it's trading $1 billion off from its underlying asset value, guys, I would rather buy this to get an immediate 6.6% cash flow than actually trying to buy a property and rent it out to someone. I think there's way more upside potential here, way less BS involved. And if I put 10 grand in it, I immediately start making $50 a month, $666 a year. So consider subscribing, because I'm going to try and find a way to integrate this one into my portfolio, because you have to remember, being a Canadian, guys, the government gives you the best tax benefits imaginable buying companies that are highly leveraged and focused in building in Canada, at least 50% of their income, right? So you end up paying substantially less tax than if you were to, say, buy a company that is largely exposed, or just a pure US company where you're paying that withholding tax as well. But I pass the question off to you. What do you guys think about this REIT? In that comment section below, I'd love to hear about it. And I feel like an idiot because I refuse to look at it. And I know a lot of you guys throw REITs at me, like H&R. There's like Northwest Properties. I think it's in Northwest. There's a lot of healthcare REITs that I look at. At the end of the day, guys, Canadian real estate seems to be where it's at. So stay cool, stay awesome, and I look forward to catching you tomorrow.